This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Darius back on the show. Now, let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Darius's picture saying, looking for the downloads. Okay, Eric, what are your thoughts on equity markets here?
Well, once again, we're flirting with all-time highs, and I think it's just more confirmation that Trump's policies are gaining traction and popularity with the American people, despite the media's constitutional crisis tantrums, which, as far as I can tell, the public is finally starting to wake up to for the nonsense that they truly are.
Okay, Eric, well, on page 2, I have the chart of the S&P 500, and we can see it's trading along 52-week highs. The big question, does it break out? I think there's lots of room for it to break out. The bigger question is it a sustainable breakout? And in my mind, there are only two things that can happen that is going to make the breakout sustainable. Otherwise, it will be a fake-out breakout that maybe we have a quick punch to 62 to 6,300 on the upside, and immediately it fades all the way back down. So one of the first things is that it would need to have a widening of market breadth. On page 3, I have just the percentage of stocks trading above their 50-day moving average in the S&P 500. And we've been pinned in this 50 to 60% range for a month now. Basically, when you look at something like the equal weight S&P 500 is nowhere near its high the way the S&P 500 itself is. And so we would need a broadening of the market in order for this to have a sustainable move where we'd go into 85% of the stock market participating, and that broadening of the market sees a sustainable bull advance that could see, let's say, 64 or 6,600. The alternative to the widening of the breadth, on page 4, I have the Magnificent 7 ETF, which is talking about the MAG stocks. And they simply have been huge laggards over the last 2 months. They simply have not broken out, not had any momentum, and many of them are rolling over. And so if you don't have a broadening of the whole market, then you need the MAG 7s to regain their leadership. And if one of these two doesn't happen, then you can't trust an S&P breakout. And in my mind, the S&P will potentially here spark out a quick breakout that gets the attention of the media. But if we don't see the underpinning conditions confirming that, then I would be fading that breakout. If we did see that fade happen where it wasn't confirmed, what would be the first warning signs? Well, if a breakout fades and gets down to like the 6,000 level on the S&P and a quick 5% market correction, if we see that kind of damage done, then I would start to speculate that the first quarter high is not only in, but then that there actually is room for a bigger or deeper market correction. Now, before we talk market correction, I want to first see that the bulls fail to hold these gains. And so right now, we're going to give the bulls the benefit of the doubt. They just need to prove that this thing is real. If we don't see that, then I will quickly flip to the short side. Okay, let's move on to the dollar here. Eric, what's your thoughts?
The prior consolidation range was 107 to 110. We saw a multi-day breakdown below that range this week, but we just closed over 107 on Wednesday. So the question now is whether we re-enter the consolidation zone and stay above 107, or if the sell-off is going to continue below 106.5, which is the low we put in just a couple of days ago. Patrick, I'm leaning toward a continued sell-off on continued speculation about the Mar-a-Lago Accord thesis, which Jim Bianco described in last week's MacroVoices, and which Zero Hedge has since picked up and begun reporting on. Actually, they're reporting on the gold revaluation hypothesis. They haven't quite got to the Zoltan bonds yet, but I'm sure they'll get that story too. From a technical analysis perspective, it's still early to call a new downtrend in the dollar, but I have a feeling that's where we're headed.
Well, Eric, there are an increasingly large amount of people starting to talk about the idea that the US dollar top could be in based on the fact that the administration wants a weaker dollar. I'm not so sure I'm ready to flip to that camp yet. As far as I'm concerned, we had an extraordinary bull run on the upside of the dollar, and that's seen on that chart, and we broke out of that 2-year trade range bullishly on the upside, and we're now approaching what were the previous highs where they potentially can act as support. With the fib retracement zones down here, I think a dollar could easily still consolidate 1 or 2 more points down to this 105 to 107 range and still turn around and be bullish. And so to me, I want to first see whether supports come in here and whether bulls can sustain a rally on the other side. If we see that the dollar rallies start getting heavy, fail to follow through, and start rolling over, I'll start entertaining a more bearish thesis then. But right now, I'm giving the bulls the benefit of the doubt that they're going to hold the line somewhere in here, and we're going to see a meaningful rally back up towards the highs. All right, Eric, let's move on to crude oil.
Well, we saw a brief test of that critical 100-day moving average at 70.11 on WTI, which I emphasized in last week's podcast. That was followed by a nice bounce all the way up to the 200-day moving average at 72.66. And now we're retracing back to the downside. It's not clear how far we're going to go. But keep in mind, the entire Arab world is in shock over President Trump's messaging about annexing Gaza. So there's definitely room for an upside price spike induced by geopolitics if the ceasefire doesn't hold.
Well, Eric, I'm in the camp where I do believe that the low end of crude oil has been established, and we have now gravitated toward the bottom end of that range. Is there a few more dollars downside risk to oil that could potentially materialize? Sure. But generally, I think that we're at a level where there's still asymmetry, where I don't think that there's a room for a big breakdown in oil, and ultimately just some new catalyst has to be introduced that potentially could start up a move towards the top end of its range. Now, I'm not super bullish oil where I think, in the next year or two, we're going to see 100 or 120 on the upside, but could we see us gravitate back into the mid 80s to the top end of the range we've seen over the last couple of years? I think that's entirely plausible. So while we haven't seen a bull breakout here that is really showing the next move, I do think that we're at very key support lines that are likely to hold. Now let's talk gold.
Well, as I explained last week, the technical setup was ripe for the market to roll over, and it was a good setup for maybe a multi-$100 correction because we were massively overbought. Well, that's exactly what started to happen on Friday. We painted a massive red candle, dumping $80 in a single day. Boy, it sure looked like that market was rolling over and maybe headed several $100s lower. But I traded emails with Jim Bianco over the weekend, and based on Jim's gold revaluation hypothesis expressed in last week's podcast, Jim and I both agreed that this dip was likely to be bought sooner than later. And that's exactly what happened from the Sunday futures open. Right out of the gate, there was a very brief spike down for a new undercut low below Friday's low. But that didn't last, and from there, the retracement higher was underway within minutes. And by Tuesday afternoon, we were once again flirting with all-time highs. So despite that the technicals still very much suggest that we're still overbought here, maybe not extreme overbought like we were on Thursday, there's definitely room for a ongoing correction several $100s lower. But the thing is, all of these dips keep getting bought faster than anyone expects. Bottom line, I'm leaning toward an upside breakout to new all-time highs and above the price channel that began in October 23. I think that's more likely at this point than the technicals would seem to admit. There are two reasons for my extreme bullishness here. Number one, these dips just keep getting bought faster than makes sense in a normal market, as if there's something more going on behind the scenes in this picture. And number two, the rapidly growing popularity of the gold revaluation hypothesis that you heard about first from Jim Bianco on last week's MacroVoices podcast. Now, all of that said, even if we did get a $200 downside correction from here, which is still possible, that wouldn't invalidate the uptrend. Channel support is just above 2,700 now, so it would take sustained action below that level to invalidate the uptrend.
Yeah, Eric, that completely all makes sense. We are very overbought on the short term. Some of my upper target zones are in this 3,000 to 3,050 area on the upside. And at some point here, we are going to bump our head on the upper end of gold and begin some sort of mean reversion and correction. And like you were suggesting, even a $200 pullback, which is actually quite typical in gold, wouldn't be a break of the primary uptrend. It would simply be a consolidation of the advance and could be the base from which continuation patterns will occur in the second quarter of the year. At this moment, it's hard to justify this as a new tactical entry level of gold, but at this point, the trend is primarily your friend. We continue to have higher highs sequentially each day. You want to respect this upper trend, recognizing, though, feels very 8th, 9th inning of this part of the advance. And at some point, gold will go through a profit-taking cycle of some sort, but that wouldn't be something that would shake me out of the trade. And finally, Eric, let's just touch on uranium. What do you think here of the way that it's behaving?
Well, it's been another week of mostly bullish nuclear news flow and another week of spot uranium and uranium miners plumbing new cycle lows, defying the bullish fundamentals. The uranium market seems to be puking over President Trump's nuclear disarmament comments when he suggested that both Russia and the United States don't need as many nuclear warheads as they both have. That led to what I think is completely misplaced speculation about maybe a version 2 of the megatons to megawatts program, which dramatically reduced the excess inventory of high-enriched uranium that Russia was holding back in the 1990s. Look, it's a completely different situation now. That was at the end of the Cold War that the original megatons to megawatts was negotiated. At that time, Russia and the United States both had tens of thousands more warheads than they do today. Also, that was not really about disarming and dismantling warheads the way most people think it was. What megatons to megawatts program was actually about was Russia's agreement to sell 500 tons of surplus high-enriched uranium. It wasn't that they disassembled 20,000 warheads. It was that they took 20,000 warheads worth of surplus high-enriched uranium, about 500 metric tons of high-enriched uranium that they had in surplus, and sold that to the United States. Now, if something like that were to happen again, which is frankly unlikely in the first place, if it did happen, then it would be a smaller number. It wouldn't be 500 tons because I think they've got more than that, but they don't have anything close to what they used to. Whatever did happen, it would make exactly 0 sense for anyone to even think about downblending it all the way to low-enriched uranium. What we need right now is HALEU. That's the high-test uranium fuel for the new generation of reactors that are just starting to be built. From an economic standpoint, it makes no sense to downblend all the way down from high-enriched uranium to low-enriched uranium when it makes so much more sense to stop not quite a little more than halfway down that path at HALEU, which is about 19.75% enriched as opposed to 5% enriched, low-enriched uranium. The point is, if there was any kind of megatons to megawatts 2.0, it would be to make HALEU. That would go into reactors that haven't even been built yet and that are not part of the equation for evaluating the current market and all of the deficits that people have projected. In other words, it's just not going to matter. The bottom line for actual uranium consumption is that we're going to consume as much U3O8 as we have capacity to convert and enrich. That's what is throttling U3O8 demand right now, is limited capacity for enrichment and conversion. If they were to downblend a bunch of HEU in order to make HALEU, or in order even to make LEU, which doesn't make any sense, it still wouldn't change the fact that we need more LEU, and therefore they're going to continue to convert and enrich as much as we have conversion and enrichment capacity for. So it's not going to affect U3O8 demand, even if it happened, and frankly, I don't think it's going to happen. But the retail freakout that occurred in reaction to those comments definitely underscores the fragility of this market. On Wednesday, URNM dumped to extreme oversold, all the way down to an 18 RSI, while URA dumped to oversold with a 31 RSI, just teetering on extreme oversold there. Both of those are still pointed down, suggesting even lower numbers may still be to come into next week. So it's definitely time to be buying here, not selling. Remember, folks, the idea is to buy low and sell high. We're definitely into oversold, if not extreme oversold territory here on most of these issues. But I still have reservations about all the experts that are making the call saying, okay, the retail capitulation is now in. That means that it's definitely time to make your big buy because it's not going any lower than here. Look, there's so much retail participation in this market because institutional investors were locked out of uranium for ESG mandate reasons and have only just begun to dip their toe in this market. So it's completely dominated by retail investors who are famous for doing the stupidest things at the stupidest times. So if we continue to get news flow, as much as I don't think there's going to be a meaningful megatons to megawatts 2.0, that doesn't mean President Trump is not going to say we're going to have some massive megatons to megawatts program it's going to be fabulous. It's going to be tremendous. If he starts saying things like that, I think it's going to freak retail investors out, and you could see a full-scale capitulation at that point. That would be the time to really start buying hand over fist. Now it's only time to be buying hand over hand, in my opinion. I think the hand over fist buying opportunity might still be to come. We'll see what happens. At the end of the day, though, one of two things must happen here. Must happen. Either all of these new nuclear plant builds and all the nuclear plant restarts and all the nuclear plant life extensions that have been announced in the last few weeks and months, either they all get scrapped and that whole plan gets completely, totally reversed, and that would probably take World War III in order to reverse all of those things, or they're eventually, not sure when, but eventually going to have to start buying fuel for all those reactors, both the old ones that are coming back online and that were not budgeted fuel for, as well as the new ones that are being built. So it's one or the other. Either all of this entire nuclear renaissance news flow that we've been hearing gets completely, totally reversed, despite the fact that Chris Wright and President Trump and J.D. Vance and everybody else are all saying that the U.S. government is now completely behind it. It all gets scrapped and the whole thing goes in the other direction, or sooner or later, they've got to buy uranium. Now, that doesn't mean we can't have a retail capitulation freak out between now and then. Maybe there's going to be even better buying opportunities. But right now, the buying opportunities are strong. If you're not positioned at all in uranium, it's a great time to be buying.
On page 8, I have the Sprott Physical Uranium Trust chart up, and the chart just looks awful in a sense that it's being regularly distributed here. Lower highs, lower lows on the downside, and just being unloaded. Overall, I do actually think there's a very important target zone right here in this $20 to $21 range where we could see the selling at least subside. But whether or not we start finding support lines or bases, it's very likely here that this is going to go deep into March in consolidation of some sort before there's room for a bullish turn up. While I do think that the bull thesis in uranium is still very much intact, the bigger puzzle to solve is when will we start seeing bulling again in this space? And that currently is not evident, and you have to at least anticipate a few more weeks, if not a month, of basing to have to establish a key turn point of where this can technically start to turn up.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.